My name is Big Mike Zlotnik, and welcome to Tempo Family. We're all about helping you find great, predictable, reliable, conservative investments in commercial real estate. If this sounds like the kind of a journey you like to take, join our community by subscribing. Let's do this together. Hey folks, this is Big Mike Zlotnik, and today we're going to discuss where to get yield in the current environment. We're going to compare and contrast private credit versus absolute triple net industrial type of deals, the type of risks, returns, and other things. So in late part of 2025 and looking into 2026, investors are chasing yield. On one side, private credit offers 9 to 11% interest income per duration and typically floating rate upside. On the other side, with triple net industrial investments deliver 8% plus cash flow from the start, tax shelter depreciation, and IRRs in the mid to high teens, with arguably similar level of risk. The right choice depends on the kind of income, tax efficiency, and long-term stability investors really want. First, let's cover the yield snapshot. So private credit portfolios today typically generate 9 to 11% annualized. Of course, there's a little bit of a range, but the maturity is up to 2 years, in some extreme cases, 3 years. So most of the private credit maturities range from 1 to 2 years or less. But the forward expectations are moderating, with Fed signaling 3 to 4 cuts next year and likely more cuts this year. Base rates like SOFR, secure overnight funding rate, are expected to trend toward mid to even lower part of threes, which will compress returns as floating yields adjust downwards. Meanwhile, absolute triple net assets are trading at the cap rates in the high 7s to the high 8% cap rates, with high credit quality tenants, strong lease terms. And you can finance it with a positive spread of at least 1.5% to 2%, in some cases even more. The spread between the cap rate and the interest rate, mortgage rates. That's a positive spread of at least 200 basis points, as you could see here, and typically translates to 8% plus annual cash on cash return today. If cap rates compress as interest rates fall, as projected by the forward outlook on Fed action, investors could see another 50 bips, 0.5% roughly, of valuation lift in 2026 and beyond. In other words, as interest rates come down, the returns on equity come up. So that's the biggest difference between the return expectations on private credit, where the yields are expected to come down, while in the absolute triple net industrial, returns are expected to improve with interest rates coming down. Next, let's look at total return and IRR potential. So private credit positions typically generate single digit or low double digit returns. Again, 9 to 11% is a typical range, often capped at the coupon rate since loans are short term and the principal is repaid within 1 or 2 years. You get modest yield, but no appreciation. By contrast, well-bought triple net industrial properties provide 8% annual cash flow plus appreciation upside, driven by 8% annual cash flow plus appreciation upside, driving to mid to high teens total IRR. Let's call it 15% plus over a period of, let's say, 5-year hold. With 2 to 3% annual rent escalations baked into many leases, that income grows predictably each year, compounding your yield, compounding your returns. Next, let's talk about tax efficiency, the secret multiplier of wealth. So private credit, biggest drawback, interest income is taxed as ordinary income at the investor's highest marginal rate. Of course, it's a little different if you're using self-directed IRA funds. Typically, interest income is exempt for self-directed IRA. But for cash investments, return on private credit is taxed at the ordinary rates. In contrast, triple net industrial investments qualify for 100% bonus depreciation under the newly enacted One Big Beautiful Bill, which permanently restored full expensing for assets placed into service after January 19th, 2025. This means you could shield years of 8% annual cash flow from taxes through the bonus depreciation. And combined with other benefits, investors can compound wealth tax deferred for years to come. On an after-tax basis, triple net assets can outperform private credit by several percentage points per year easily. Just look at the tax-adjusted 9 to 11% versus, let's call it 8% cash flow that is tax shielded. Of course, there's a period. Next, let us look at risk and downside protection. Private credit is generally senior secured, meaning that it is the first lien mortgage on either commercial or residential properties. If credit spreads widens, defaults rise, or base rates fall too fast, returns compress in private credit. Triple net industrial deals, especially with high credit quality tenants, carry very comparable risk. Yet they're typically financed at only 60 to 65% loan to value leverage with fixed rate debt. As your tenants keep paying rent regardless of rate gyrations or market volatility, the property itself acts as a tangible collateral, not a promise of future cash flow. Next, let's talk about duration and predictability. Private credit loans, as I mentioned, are short term, typically 1 to 2 years, in some cases 3 years at most. So the reinvestment risk is high. As Fed cuts rates, investors may find their next rotation yield lower than the current locked-in coupons. By contrast, triple net industrial leases span from 10 to 25 years with built-in annual rent growth and renewal options. This creates predictable inflation-hedged income, ideal for many investors, family offices, and high net worth individuals seeking continuous stable distributions. Let's talk about macro tailwinds. Falling interest rates mean opposite outcomes for these two asset classes. As much as private credit is popular, lower rates reduce coupons and compress returns. But in absolute triple net real estate investments, lower rates compress cap rates, raising valuations and enhancing IRR. So the Fed's path forward is easing for the rest of 2025 and into 2026. This setup favors triple net assets from both a yield and appreciation standpoint. The bottom line, why triple net industrial deals win today. Let's compare and contrast. So expected yield, private credit, 9 to 11%, taxed as ordinary income. Absolute triple net industrial deals, 8% plus cash on cash distributions, tax shielded by depreciation. While triple net industrial target returns are in the 15% plus range, let's just call it mid to high teens, between the cash flow and forced appreciation clause through rent escalation clauses. Tax efficiency is very poor with private credit because it's taxed at the highest marginal rates. With the absolute triple net, tax efficiency is excellent with 100% bonus depreciation acting as a shield. Duration, short duration, 1 to 2 years in private credit typically, while many of the triple net industrials have 5+ years predictability, growth, and cash flow. Risk profile. Private credit is considered to be the safest secured lending type of returns, but the absolute triple net has a very comparable level of credit real assets collateral. Sensitivity to rate cuts, private credit has negative sensitivity, yield drops, while the absolute triple net has a positive sensitivity, cap rates and compression. In summary, when you adjust for taxes, leverage, and duration, absolute triple net industrial clearly stands out. It combines the yield of fixed income and tax advantages of real estate and the capital appreciation of equity. With falling interest rates, stronger tenant credit profiles, and 100% bonus depreciation restored, today's environment offers a rare window to lock 8+% tax sheltered cash flow and mid-teens into high teens IRR in assets that stand the test of time and market cycles. That's why in late 2025 and 2026, smart money is quietly shifting from private credit towards absolute triple net industrial, where the yield is real, the cash is tax efficient, and the upside is tangible.